Okay, perfect. We are now live shortly after 7 o'clock on Tuesday. Uh, every time I go to set up, it takes a little bit extra or more time, but I guess that's just kind of the way it is. So hopefully you can see the presentation that I'm going to do today. I've got my cue cards, so I'm going to use some of these just to before I get into the actual deal that I want to go through, which is 120 unit, I think it's actually 121. It doesn't really matter. Before I get into this deal, I thought it would be better to give context to some of the details on this specific deal. Hey, morning, Dan. Good to see you, man. Um, And so this will be really helpful for Dan and I know there's going to be probably a few other people whether or not you guys come on live or watch it after. I think that this will be very helpful in understanding how to underwrite an apartment deal. But what I thought would be even more important is to kind of talk a little bit about um, how I came up with this, because one of the biggest things that I think uh, everyone needs to understand when you're looking at any type of an investment is there's always going to be assumptions, and in those assumptions is really will dictate whether or not you kind of pursue a deal or whether or not you kind of veer off. And the quality of those assumptions are critical. And what I found, I'm going to go on a little bit of a rant because so yesterday I met with my partner Jason, and we were going through some tender documents that came back from general contractors. And we'd used one general contractor in the past, and he had done a very good job for us. And we kind of just assumed that we were going to get, the best pricing from them, and we would just kind of just make it easier on ourselves, if you will. Well, when the numbers came back from just high level budget, uh, they weren't. They were much higher than we had anticipated. And to make sure that we were protecting the interests of our limited partners, we decided that we needed to go out to the market and find out whether or not these numbers are accurate or not. And so what we found out was that when we went to the market and we pushed back, so instead of taking the assumption that the number was going to be, let's just say 2.6 million, we went to the market and found out that it was actually about 30% less than that. And so that is like the difference between being profitable and unprofitable, just by testing those assumptions and not accepting what someone gave to us up front. The other interesting thing that happened yesterday when we were in that meeting, because we went through all the tenders and we looked at all the different numbers, and then we had a little bit of time before our next meeting, and we started to review 5 different deals that were on our desk. And some of the deals were land, some were multifamily, some were retail. And this is where I got really pissed off. One of the brokers had put out a package and had a bunch of underwriting in it in terms of what a 1 acre. I don't want to get too specific because I don't want to throw this broker under the bus. They were really swimming outside of what they were outside their swim lanes. Like, they don't understand multifamily, and it was pretty clear. However, they tried to, and so what happened is all the numbers that they were putting in there, to an average person, they probably wouldn't have picked up on some of the nuances. But when you compound 4 assumptions that they made that were all like, and I can say this, they were all completely incorrect, because I know what the numbers are, and it only took about 5 minutes of research on one of the numbers to find out that was bullshit, and then to find out all the rest of the numbers, they didn't line up either. So the reason I'm saying this, and I'm going to get into some of the assumptions and the numbers that they had put in there, because I think it's important. Because I'll back up. I was thinking, how would someone know whether or not these assumptions are correct? And I realized that 3 of the 4 assumptions would take kind of like a very an expert to understand that, if you will, or someone that really understands that market. But the first assumption that was made, which was, what is the rent on those? So it was. I'll give you the lay of the land. It was a 1 acre parcel. They were looking for about $5 million. They said they could build 30,000 square feet of retail. So it was a mixed use development, and up above it, you were going to do 4 levels of multifamily. Okay, so I'm just going by memory, and I have some cue cards just in case. Okay, so 30,000, 80 multifamily units. The assumptions that they made, so there were 4 assumptions that I picked apart, and this literally took me less than 5 minutes. Now, I didn't go into great detail because once I realized the first assumption was wrong, I realized that I could probably start to pinpoint some of the other ones. The first one was the rent per square foot. Now, rent per square foot doesn't mean a hell of a lot to people that are outside the commercial real estate world. Like, renters don't talk about $1.50, $1.25 rent per square foot. Developers, investors talk like that. So I said, okay, well, what is $1.75? What does that even mean? Well, first I need to find out what the average square footage of those units are. So I did some research, and I found out in this particular case, it was going to be 1,275 square feet was the average. I think that's what I had. Was it? Doesn't matter. Let's just say it was 1,275, 1,280, whatever the square footage. So 1,275 times $1.75 a square foot was about $2,200 and I thought I had that written down. Yeah, it works out to over $2,200 a month. And I know that market is $1,500 a month. So immediately they're anywhere from $700 to $750 off, which means that could be the difference between, well, that is definitely the difference in the profitability. Now, I'm not even going to get into the details of, they were basing $1.75 based on the gross square footage of the building, not taking into consideration that there's going to be hallways, there's going to be common area. So you're going to lose anywhere from 15 to 20%. I mean, depending on the configuration, let's just say 15%. So all of a sudden, their rent per net rentable square foot starts to go even north of $1.75. So you don't even need to get into those kind of details. Just understand that is like another level of kind of assumptions and research. So that's kind of the second part that I picked apart. The third part was their expenses. They were operating on a 13 to 14% expense ratio, which is just like, at that point I realized that these guys had no friggin' clue what they were doing. And the challenge though is that their pro forma showed a $10 million profit. And so if someone was to take that and then say, you know what, the brokers gave me this, and they have all these exclusions and disclaimers and all the rest of it at the bottom, and then they were to use that same information and give it to prospective investors saying, here's a development opportunity where we want to raise, let's just say they want to raise $10 million, and we're gonna double your money in 24 months. Well, and they used all these assumptions. Most people wouldn't know, because I mean, I don't have it with me, but it was like 4 pages of financial reports and numbers and Excel spreadsheets. And it could be extremely overwhelming and complicated. And I think the average person would just look at that and say, yeah, that looks great. I mean, I trust you know what you're doing. And there's even a lot of investors that probably would accept a lot of that as fact. And so, so the rent per square foot, the gross versus net rentable, the expense ratios out of balance, and then their parking costs at $20,000 a stall versus the truth, which is closer to $35,000. And if you have to go 2 levels, you're probably close to $50,000 on that. So if you go deeper, it costs more money, at least here in Calgary. So all that to say that I didn't even have to spend any time on it. And it's not to say that these guys no one does this generally intentionally. It's just they might be taking those numbers from the seller. They might be just kind of pulling numbers from other reports. But the truth is, it's those assumptions need to be tested. And at the end of the day, I always feel that it's critical for any investor, whether you're going to be active or whether you're going to be passive, to understand what the assumptions are and then to question them. And if you don't know what they are, because I've even got some of my limited partners and clients that invest in my own deals, they will come to me and say, "Hey, Shane, this was brought to me. Could you look at it? Can you underwrite it?" And for some guys, because they've been partners with me for a long time, I just do it because it might take me 10 or 15 minutes. In other cases where I'm going through like a whole package and it might take me, up to a day, then they might invest, say, $1,000 to $5,000 for me to kind of review that. But what it does is it gives them peace of mind. If they're going to put $500,000 into a deal, and they're a doctor or a professional that is extremely busy, they have that like basically it's like they don't have the time or the expertise or I guess those would be the two main things, or maybe even the energy or desire to kind of research it. And so they say, "Shane, can you do this on my behalf?" And so for some of those clients, I'll do that. And I know in one case in particular, it saved a gentleman close to $500,000. So that because it was the wrong investment, and it was proven that the assumptions and the group that was putting the deal together, unfortunately, they just weren't the right group. So not to say that every time, but what I want to talk about now that I'm off my rant, is what you're going to see here are some of my assumptions. And I'll tell you some of the assumptions that I made, and I'm not expecting you to accept any of these. What I want to do is I'm going to give you some of the assumptions, and those are kind of closer to the end, because the way that I underwrite a deal is I kind of go through a 5-step process, which we'll get into. And it generally starts with, where's the property today and where's the property into the future, or where do I think the property will be in the future? And so the future is really where the assumptions come in. Now, sometimes what you're going to see is people, brokers in particular, will have what's called a pro forma on year one income. And that, when I see the word pro forma versus T12 or trailing 12, it's the difference between trailing 12, which are actuals. Trailing means like what happened in the last 12 months. It could be trailing 3, trailing 6. That would mean 6 months or 3 months. Versus a pro forma, which brokers will typically say, use the word stabilized. And that is a key word, because stabilized means this is what the market, this is what it should be. It's not what it is, it's what it should be. Well, there's a lot of things that should be. The property manager should have it, fully rented and whatnot. So it's just important to understand those kind of key distinctions. And we will get into some of that here. Although my goal, actually, so I went through that. Here are my, this is, put this here, this is just a couple of pages, just to kind of give you an idea of how much underwriting goes into one deal. And so what I did, this is step 5. Okay. So this is my underwriting. So basically, for me to create this, so if you're listening to this on the podcast, I would encourage you to, at this point, if you could, and I'll have it in the show notes, go check out the video so you can kind of watch how I go through this deal. And I'm going to do as good a job as I can at explaining it, so that you can kind of understand kind of the big picture of how to underwrite a multifamily or an apartment deal. But I would imagine that it'll be more useful to actually see some of the demonstration in the video. But we'll do our best if you're just listening to this afterwards. So this is a 120 unit deal. This deal is in Houston. I believe it's probably sold right now. I looked at this a little while ago, and for various reasons, it didn't make sense for me to write an offer on it. However, I think based on its location, which I'm not going to talk about because it's not important. At this point, what's important is we are looking at the specifics of underwriting a deal and showing you kind of what's possible with this type of value add apartment. Okay, so it's 120 units. The ask was $7 million, which is about $57,500 a door. I like to break things down to units that I understand. And so you're going to see quite often I'll break it down into what am I paying on a per door or per unit basis. You're going to see that on expenses. You're going to hear that when I talk about rent on a monthly basis. It's just, it's what I understand. And so when I can understand something very quickly, then I can evaluate it much easier. When I talk about $7 million on 120 units, that's less meaningful than $57,500 a door. And the reason that's less meaningful is because at $57,500 a door, I know that hits one of my 8 non-negotiables, which is I'm buying below replacement value. Okay, so if I was to just do what I call like my 5-minute back of the napkin, and this wouldn't even take me 5 minutes. I could literally do this in probably like 60 seconds with a scrap piece of paper. Like, I mean, if you were to watch, like I don't know if you can tell on this piece of paper or not, and you don't need to because it's kind of chicken scratch. But I basically looked at what's my effective gross income. So my effective gross income is the total income that I'm generating from this property, and I assumed it to be 1.25 million. Okay. Then I take off the 10% vacancy factor, which I felt was reasonable in this neighborhood. So I get just over $1 million in. This would be my effective gross income after the vacancy. So effective gross income is all the income that I'm generating minus any kind of concessions and loss to lease, which we're going to get into. Okay, so this number here, this is a big assumption, right? In terms of like, did I calculate my effective gross income correctly, which I will show you in the next case. However, I just more or less took what the brokers gave me. I applied a 10% vacancy. I came up with $1,125,000 or $1,012,500. Sorry. I put in the 10% vacancy. I come up with expenses, and I just used a rule of thumb of 50%. Okay. So what I'm going to end up with is, this is really the big number that everyone wants to narrow down and focus on, which is your NOI, or your net operating income. This is the income that you will generate after all the revenue is collected minus any expenses, and this is before your mortgage and before taxes. Okay, so this is truly a number that you could essentially see in your bank account if you had no mortgage. And then the next assumption is, so the NOI is not necessarily an assumption, it's a calculation. The cap rate, which is probably the easiest way to explain a cap rate, is if you purchase this property at $7 million, all cash, and you just got a 6% yield on your money or a 6% return, what would that equal? Well, in this case, if I'm generating $506,000 a year in net operating income, and I am willing to accept a 6% return on my money, I could essentially pay $8.4 million. So this is just a back of the napkin. Now, you're going to see when we dig into this, the expenses way off, and my effective gross income is off because 10% vacancy on this building was optimistic. Going in is far different than what it should be. So let's get into that. All right. Step one. Step one is all about figuring out your income or your revenue. And so there's going to be some terms here, and I thought I'm going to use the terms at the risk of knowing that maybe some of those terms are not well known or understood. And what I'm going to do is I'm going to create like a resources on my website. It's not live yet, but it'll be at shanemelanson.com, probably /resources, something simple. And I'll go through all of the different terminology. So I'll do my best to explain the terminology here. However, the purpose of this video is not to give you all the different definitions, because this could turn into a half-day workshop just on how to underwrite a deal. Like it could be a full-day workshop, because it's taken me years and like thousands of properties to underwrite to understand the nuances, what to look for. So I'm not going to get into the nitty gritty. I want you to get the big picture so that you can really evaluate whether or not a deal makes sense at a high level before you spend a lot of time trying to dig into it. Okay, so GPI is your gross potential income. Think of this as what are the market rents. Doesn't mean that the actual rents, they're what the market is. So let's say the market is $800 a month. You would times that by the number of units times 12. So in this case, for this property, it was $1,125,000. There was other income, and that other income could be from trash. It could be from parking or garages or something to that effect. So there was another $125,000. So you add $1,125,000 to $125,000. Now I start to subtract. So loss to lease. This is a bit of a more complicated number to understand, but for the purposes of this demonstration, I'm gonna assume that loss to lease is the difference between my market rent. Let's say it's $800 is what other properties in the area are generating versus what this property is getting. And so let's say that this property is closer to $750 a month, just for argument's sake. Well, there would be a delta, and I'd have to subtract that because the gross potential is what it could be. Doesn't mean that's what it is. So my loss to lease, I'm going to subtract 5%. Concessions, think of that as a free month rent to entice someone to come into your property. That's probably the easiest way to understand a concession. There's other concessions, but we're not going to get into that. Bad debt, that's where people have not paid. That's the easiest way. And vacancy, that's pretty straightforward. Essentially, this here is going to yield, once I add all these numbers and subtract out anything that's negative, I'm going to end up with my effective gross income. And this is really the most important number as it relates to income, okay? So this is really how much revenue this property is generating. So once I got my effective gross income, I go to step 2 and I look at my expenses. And I'm showing you the expenses based on a per door per month basis because that's how I understand it. When you're dealing with 300, 400, 500 units, it's much easier to break it down on a per door basis. If you're doing a 20 or 30 unit of building, sometimes it might not make that much of a difference. But what I'm going to do is I'm going to give you 2 ways that I underwrite these deals. The first is what I called, and I alluded to this in the past, which is your T12. And the T12 is the actuals that we saw on the financial statements that the property was generating. Okay, so this is going to be the actual numbers here. And then here is what I would call your pro forma. And your pro forma is really stabilized, or what the numbers should be. Okay, so there's generally going to be a difference between the two. And I didn't list out all the different expenses on this property because it's not important. I'm going to give you the final number that I came up with, both on a T12 basis and both on a pro forma basis. But what I'm going to just kind of mention, and this is in Houston, and for this asset class, this would be probably a C, maybe a B property in a B area. Okay, so now when I underwrite a deal, especially in Houston, typically I know that the taxes, because it's I think the term is a non-disclosure state, so they don't have to disclose the value of the properties. But what I know is the assessors in Texas, they have their ways, they're smart, they know what's going on. So I know that when I buy a property, so let's say I pay $7 million for this property, but it's currently being assessed at $3 million or $4 million, that I'm going to take the mill rate, which is, I'm not going to get into this. The mill rate is essentially what the city or the county will charge to collect taxes. Okay, so I think in this case it's like 2.7%. So 2.7% times 80% of my purchase price. So on $7 million, whatever 80% of that is times the mill rate is going to equal the total taxes that I'm going to pay on this property. Generally speaking, I know that for this type of property, I should be about $1,000 a month. The insurance, anywhere from $300 to $650 a month. Now, I know that that's a big gap, but a lot of it has to do with, especially in Houston, with flooding, and if you're in a flood zone or not in a flood zone, or what type of, just like wind and insurance claims in the area. So that does fluctuate, but the easiest way is just to call an insurance broker and get a quote. The other thing is whether or not, like, how big your carrier is. I know when we were in the US, Greystar, which was the property manager of the company that I was working with, they've got such a huge portfolio, like 200 to 250,000 units. They can drive down that cost. Okay, so that's just something to keep in mind. Contract services, think of that as your landscaping and just kind of day-to-day maintenance around the place. Trash pickup would cost anywhere from 30 to 50. Utilities, I kind of budget around $750 a month. Management fee, anywhere from 3 to 5%, kind of depends on how big the property is. R&M, so that's your repairs and maintenance, at $650 a month. You're going to see this number. I put some asterisks by some of the numbers that we're going to talk about in the future. Your G&A is your general and administrative fees. I put that in at kind of $250. Think of that as bookkeeping, legal. You've got payroll at about $1,100. Like I said, this is all pro forma. These are all budgeted numbers on a per month basis. Marketing, anywhere from $100 to $150 a month. Replacement reserves. This is what the bank is going to want to see from you, and this is really money that you would want to put away for kind of capital expenditures, maybe a new roof, maybe you got to do air conditioning, parking lot. I mean, there's going to be money that you want to set aside, and this is kind of a good rule of thumb. All right. Now, the actuals on this property when I underwrote this were $6,900 a month. The pro forma should have been $5,900, so it was almost $1,000 off. And you're going to see how much of an impact that makes. Okay, so step 1 was income, step 2 was expenses, step 3, I want to figure out what the value is today. So I take my effective gross income, which is $1,075,000. I subtract the expenses. Now the expenses on this property were $840,000, which I believe we're running at about 78%. So I know something's wrong right there, but I don't know what's wrong. So I just say, what is the value today? I calculate my net operating income. Now I'm at $235,000. I take my net operating income, my NOI, divided by the cap rate, which is the yield that I want to receive. And that's going to give me the value of the property. So I take $235,000 divided by 6% is going to equal $3.91 million, or $32,400 a door. I know that the seller's not going to accept that. And I know that if I write an offer for $3.9 million, I'll be laughed at. So, and it doesn't bother me to be laughed at, but I don't want to waste my time or their time. So this just gives me a snapshot in terms of what's the value today. What I want to find out, what really, to me, is what is the opportunity? And for me, the opportunity is finding the gap. And the gap generally comes in either in the income or the expenses. And so what I do is I say, what is the next iteration of my underwriting is to figure out what's my version of this property. What do I think that this property should really be doing if it was run properly? So I said, year 1, my effective gross income should be $1,315,000, or $913 a month in rent. I think based on the effective gross income of the T12, meaning the trailing 12 months, the actuals, it was around $860 a month, right around there, $859, I believe. So now that I know what my effective gross income is, I know what the expenses should be. They should be about 50%. They should average, $5,430 a door per year, or $658,000 in total expenses, which means I'm going to have an NOI of $658. If I use the same 6% cap rate, I get an $11 million valuation. So you can see I really didn't mess around too much, a little bit with the effective gross income, a fair bit with the expenses. I dropped it from 840 to 658, which is 180,000. And you can see that what that does to the value. I mean, 11 million versus 3.9 million. So step 5 is like, how did I get to that number? And so I'm going to show you how I increased the income, some of the assumptions I made, right? Back to assumptions. Like, these are my assumptions, and you can question anybody that brings you these type of opportunities. You want to really drill down. Are they real? Are they legitimate? But based on my experience in this market, based on the surrounding properties, and then I would have to go out and test it. And there's some different ways to test it, but we're not going to get into that because, once again, that would be kind of maybe a different class. So here are the assumptions of how I got to that new number. So I said, with a budget of $11,000 per unit, I'm going to be able to do some renovations. And if you remember back to when I first calculated the revenue on this property, it was operating at about, you were losing about 24% a year. There was 10% vacancy, there was concessions, there was bad debt. So there was a bunch of different reasons why this property was losing money. And so I figure if I can come in, invest $11,000 a door, which in this case would do a very nice renovation, I'm going to have to put in another $1.3 million of equity. Okay. In exchange, I'm going to increase the rents by $54 a month. And I expect I'm going to reduce the vacancy. So those are all the assumptions I'm making. I'm also making the assumption that with a good property manager, that I should be able to get my expenses to about 50%. All right. And execution, how do I do that? All right. Well, this is how do I describe it? This is really, when I purchased the property, here's how I believe the numbers are going to look. I'm going to have $5.25 million. So I'm buying the property based on the initial $7 million purchase price. I'm going to borrow 70% of that. That LTP is loan to purchase price. And so I'm assuming I'll get $5,250,000. I'm going to need equity of 30% plus the 1.3 million plus my closing costs. And so I figured I'm going to need about 3.2 million. C on C, or cash on cash. So this is the return that I expect I will make on this property. I believe I can get a 10% cash on cash return, which is, the way that this is calculated is, I'm going to get $658,000, which is my net operating income, minus my 332,000. You haven't seen this yet, but essentially what that is how much it's going to cost for this debt. So 5.25 million, I ran it at 4% interest rate, 25-year amortization, and that is going to it's going to cost me about $332,000 a year for principal and interest, which leaves me with $325,000 after principal, after my mortgage, which is going to give me a 10% cash on cash. And the other critical or very important piece is, what's my debt service ratio? And so my debt service on this is going to be 1.98, which I know is going to allow me to go back to the bank, refinance, pull out that money. I did that on the retail property that we did last week. But let's just say that I didn't do that. I'm happy with the 10% return. I've got plenty of debt service. My debt service, what that really means is I've got almost 2 times as much income coming in as I need to pay out, which is, it's a good feeling to have. So that is really what I wanted to discuss today. This is how I underwrite an apartment deal. I know that there was a lot of moving parts, but if I was to summarize, really what you're trying to figure out is, number 1, what is the revenue today? Number 2, what are the expenses today? Number 3, what's the net operating income? And that is going to give me what the value is. Number 4 is essentially like, what's the gap in the marketplace? Like, what is the opportunity that I think this property is going to allow me to increase the value? How am I going to fix this? Or can I fix it? Maybe I can't fix it at all. And there's a lot of properties, like I don't show you all the deals that I look at that make no sense at all, because I figure I might as well show you a property that is that has an opportunity to that I would actually put some time and energy into, because I think that's probably more useful. And then number 5 is like, how am I going to execute on this game plan, right? So for example, my budget of $1.3 million for the renovations. How much debt do I think I'm going to get? Now, is like, I didn't get into this, but I might have to get bridge financing, meaning I might have to get a lender that's going to charge me more money to be able to stabilize this property. Because if you remember, at $840,000 of expenses, it's going to be my NOI was 240,000, I believe, on existing. Where is it? It was 235,000. So if you look at that and you say, well, if you borrow 5.25 million, Shane, you're not going to be able to service that debt, which is where you might have to get a bridge loan to borrow the 5.25 million. And the way that would happen, without getting into the specifics, is the bank might say, you're right, we know that your property manager is going to be able to operate this for a lot less than $840,000 a year. However, I want to see an interest reserve, meaning I want you to put extra money, or I'll lend you extra money to be able to pay the principal and interest, or if it's an interest-only loan, so that you're able to stabilize it over 12 to 18 months. You can pay us out, and then you can go get conventional financing. That's a more advanced strategy, and I'll talk more about mortgages probably a little bit later on. But this, I think, gives you, hopefully, I think the purpose was to say, how do you kind of evaluate a deal? What do you look for? What are some of the red flags? And what are the assumptions that are being made that I should test and question? And I think that if that's all you took away from this, you don't have to worry about all the different numbers. Then that would be a win for me, and a win for you, hopefully. And the other thing is, I will have, I will create kind of a short form underwriting on my website at shanemelanson.com, and you'll be able to go there and download that probably within the next week. So keep an eye out for that. That's really what I wanted to talk about today. I hope you found this valuable. As usual, if you have any questions, by all means, you can post them. You can send them to me at shanemelanson.com. That's my personal email. And I'm happy to kind of answer questions that you might have as it relates to underwriting an apartment deal. Maybe you're looking at investing in an apartment deal, or retail or industrial, because I've got that experience in those kind of 3 main areas. And I hope you enjoyed the video today, the episode. And like I said, any questions, happy to answer them. We'll see you next week. Bye for now.